Let's talk about bond yields. We'll explore how to measure the true return on a bond investment, covering current yield, yield to maturity, and yield to call. These concepts show up frequently on the test, so understanding them is essential. Let's start with why yields matter. When you buy a bond, the coupon rate alone doesn't tell you what you're actually earning. That's because the price you pay might be more or less than par value. Yield captures your real return by factoring in what you actually paid for the bond. The simplest yield measure is nominal yield, also called the coupon rate. This is just the stated interest rate printed on the bond. You calculate it by dividing the annual interest payment by par value. So, a bond paying $50 annually on a $1,000 par value has a 5% nominal yield. Here's the catch though. If you didn't pay par for the bond, this number doesn't reflect your actual return. Current yield gets us closer to reality. It divides the annual coupon by the current market price, what you'd actually pay today. So, if that same $50 coupon bond is trading at $9.50, your current yield is 5.26%. You're getting more income per dollar invested. Just remember, current yield only measures income. It ignores any capital gain or loss you'll realize at maturity. Let's see this pattern clearly. At par, $1,000, a $50 coupon gives you exactly 5%. Buy that same bond at a discount for $9.50 and current yield rises to 5.26%. Pay a premium at $10.50 and current yield drops to 4.76%. The relationship is inverse. Lower price means higher yield. Higher price means lower yield. Yield to maturity, or YTM, is the most comprehensive measure. It calculates your total return if you hold the bond until it matures. This includes both your coupon payments and any capital gain or loss from buying at a discount or premium. Yield to maturity assumes you reinvest all coupon payments at that same rate. When someone asks about a bond's total return, yield to maturity is the answer. Here's a critical relationship to memorize. For discount bonds, yields ascend. Yield to maturity is greater than current yield, which is greater than the coupon rate. For premium bonds, it's the opposite. Yields descend. Yield to maturity is less than current yield, less than coupon rate. At par, all three equal each other. A helpful memory trick: discount means yields go up, premium means yields go down. This yield hierarchy is heavily tested. Yield to call applies only to callable bonds, bonds the issuer can redeem early. Yield to call calculates your return, assuming the bond gets called at the first call date. If you buy a 10-year bond that's callable in 5 years, yield to call assumes you only hold it 5 years. For premium bonds, yield to call is lower than yield to maturity because you have less time to collect coupons before losing that premium. This represents the worst-case scenario for investors holding callable premium bonds. So which yield matters when? If you're just comparing income, use current yield. Planning to hold until maturity? Yield to maturity is your measure. Holding a callable bond trading at a premium? Use yield to call. It's the most conservative estimate since it assumes the issuer will call the bond away from you. Let's look at a visual that ties this all together. The bond seesaw. On the left, you have bond price. On the right, interest rates. The fulcrum sits at par, $1,000. Notice how it works like an actual seesaw. When bond prices rise above par into premium territory, the interest rate side tips down, your yields fall. When prices drop below par into discount territory, the rate side tips up, your yields rise. This inverse relationship between price and yield is fundamental. Now look at the letters on the seesaw. N for nominal, CY for current yield, YTM for yield to maturity, and YTC for yield to call. Their positions show the yield hierarchy. For a premium bond, yields descend in that order. Nominal is highest, then current yield, then yield to maturity, with yield to call at the bottom. Flip to a discount bond and that order reverses. Yields ascend from nominal up through yield to call. Think of it this way. The seesaw doesn't just show price versus rates. It shows you which yield measure gives you the highest or lowest number, depending on whether you paid a premium or a discount. That's the relationship you need to know for the test. To wrap up, nominal yield is your fixed coupon rate. Current yield adjusts for market price. Yield to maturity gives you total return to maturity. Yield to call gives total return if called early. And remember that yield hierarchy. For discounts, yields ascend from coupon to current to yield to maturity. For premiums, they descend. Master these relationships and you'll handle yield questions with confidence. Thanks for watching. If you found this helpful, you can sign up for the full course and 6 mock exams. There's a link in the video description. And if you want a discount, check the channel description.